All right, we're live. Here we are. Richard with me. All right. All good over there?
Yeah.
Excellent. Let's just see what we got going on here. We got some people. Got Luke with us. Excellent. How many people we have today? Nice. Okay. Nice. Oh, and I did a little poll too. Actually, I'm just going to publish the poll right now. Because a lot of people were talking about it. Let's face it. We had the FOMC yesterday. ECB just came out a while ago. They raised, as expected, I think 25 basis points. You got the Bank of Japan tomorrow. I didn't expect the ECB to do anything. I didn't expect the Bank of Japan to do anything. I didn't expect the FOMC to do anything. And that's kind of how we played it. But you never know. You never know. These things can happen. There could be surprises. So I kind of want to know if anybody else was playing the strategy. I have a feeling that a lot of people are going to say no. And the reason why I say that is because there wasn't a lot going on in the market. A lot of people probably thought they'd just sit on their hands, or maybe thought that if the market wasn't going to move, well, what can I do? Should I sell some vol? I don't know. So it'll be interesting to see, excuse me, if we come up with yeses or nos. But overall,
yeah, my view is slightly less pro crypto. My view is that everyone who's going to buy has bought, and everyone who had to sell has sold, and the kids don't have any money to spend anymore, so they can't buy anymore. There's no credit available for leverage speculation.
Yeah, it doesn't seem like there's very much in the way of inflows right now, and a lot of people who are in are sitting on the sidelines. It's summertime. It's a great time to sit on the sidelines. A lot of institutional players are kind of, backing off. So it's quiet, and we've seen this happen in other markets before too in the summer. Now, will this continue beyond the summer in crypto? It's anybody's guess. I suspect that the market we see in October is going to be significantly different than the market we see now. But that's certainly the nature of crypto. And as you've pointed out a few times, every 90 odd days, we have a pretty significant move on average in crypto. So
I was stopped in the street today actually by a friend of ours, Nick. He was riding past on his motorbike. He's into crypto, long-term hodler, and like many people in Bitcoin, he's still accumulating as and when he gets spare cash, but not going 10x on whatever is available like we used to, right?
Yeah.
So I think it's not like crypto's dead. It's just that it just isn't the hot thing right now.
Yep, just quiet right now. We've seen that, and this is part of a market's maturation. It's it had to calm down at some time. There's going to be some wild days ahead, I'm sure. So we just need to sit through this and write it out. And yeah, the smart thing to do is to scale back. If you're going to sell vol, no problem. Just don't do it in huge size. Don't bet the farm, because it's easy for the market to get pushed around. So
I held off selling vol up until the FOMC, but now we've been through the FOMC and half a day's gone by. I'm thinking, well, if I buy vol, I'm going to lose money. So nothing left to do but sell it, right?
Yeah, and I've done the exact same thing, which I'll show everybody in a minute. I did sell some vol. I've also bought a little bit too, but I'll get to that in a second. So what we'll do here is we will go through our usual. Here, let me just queue up what we got going on here. Head over to the slides. Where are we? Trading crypto with us. So, as always, we're going to review the current market, current trade strategies. I've just put some stuff on today, actually this morning. Took some stuff off last night. And we're going to talk a little bit about using 1/3 ratio spread. Now, I don't have one set up currently. I was hunting. I was also hunting for a butterfly prior to the FOMC, but I couldn't make the numbers work. And we can always talk about that later if anybody has any questions. But Richard, you do have some 1/3s on, so you'll be discussing that a little bit later on. I'll do is
I put one in. I put a little one, experimental one in, just to see if we could trade build up some kind of trade around it.
Sure. And what we can do is I've just put a few slides together just to kind of explain what the 1/3 and the philosophy behind it looks like. So once I go through that, then it'd be great for you to show us what you got going on. Actually, let me jump over right now. I'm going to share my screen. Actually, let me just see who's here. Who do we got here? Got Cor from Holland. And of course, we've got Gian Andrea from Italy. It's always nice to have you with us. Luke. Oh, and Marbella. It is hot in Marbella, and I was talking to some friends earlier today in southern France and in southern Spain, and it is cooking there. It's not so hot where we're at now, but it's definitely hot down there. Okay, let me just share my screen. Okay. I assume everyone can see this. So this arrow, it says July 25 here, long strangle. No, it's on July 25th. That was the day before yesterday, on Tuesday evening, actually. I put it on a long strangle. I could see that volatility was not moving. It was slightly ticking up. I mean, just inconsequential, really. But I thought, okay, maybe the Fed will come out and announce something that nobody's expecting. Probably not. So I put on a long strangle. I bought the 1900 calls and I bought the 1800 puts. And you can see here, this is 1900, 1800. And this is a July 28th expire. So this is a long gamble play. I was hoping, maybe we'd go up to 1950 or, 2000, or I wasn't expecting anything crazy. It didn't happen. So I took the trade off last night and this morning. Now I lost a little bit on the puts, actually made a little bit on the calls, but that was inconsequential. So this trade is now gonzo, finished, done. That was a short term. Just thought I'd bet a little bit. It was, those options are cheap. They're cheap, super low vol. There's no premium. So that was worth it to just in case something crazy happened. So let me just expand out a little bit. We can see what we got going on here. So this morning, I color-coded everything. I got organized this morning, and I put color codes on all the different trades so that there wouldn't be all these different lines all over, confusing, right? It's like when you look at a technical analyst screen sometimes, it's like someone threw a pot of spaghetti at it, and you're trying to figure out what the hell's what, right? I didn't want that. So anyways, I did put on...
as they go along.
Yeah. I did put on a short strangle this morning. And we can see, and that's why I put July 27 here, 2,000 calls, okay? The 1650 puts. Now, in fairness, I didn't get all the 1650 puts. I was trying to make the market. I didn't want to remove liquidity unless I had to. Excuse me. So I have more calls than puts at this moment, but I still might get filled on the 1650s. And these expire August 11. Do I normally play such short term? Not usually. I mean, I do small trades like that sometimes, but I don't want to stick my neck out. I don't want to, sell September's. I don't even want to sell the end of August, to be honest. I mean, I will, but the market is so dead right now, and I don't want to be stuck in something short, and go to the end of September and vol starts to really kick up at the end of August or early September and get hosed, right? So, although a lot of the time premium would have been taken out, but if IV spikes, that's not going to matter. It's going to hurt. So I put that trade on. I'm happy with that. I don't know how many days to expiry that is. What's that? 11, about 14, 15 days or so. So that's pretty cool. And what I have been doing the last week or two is I've been slowly picking up long puts. And we can see here, I've got all actually here. Let me zoom this like this, and we'll be able to see. And I've got there. I put all these puts the same color here, just so we could see. And I'm just slowly picking these up, and these are usually around 10-ish delta. And these are just insurance policies. I'm just putting a little bit, sprinkling it all through. So if we do get some catastrophic down move, which is the danger for me, I'm not so concerned about the upside because, of course, we're trading on Deribit, and I own the underlying asset. So if it goes up, happy days. It's worth more. I'm quite pleased. The danger is to the downside. So I want to make sure that if there is a move to the downside, I'm at least mitigating some of that risk by some of these long puts, and you can see the different strikes and different expiry dates that I have going on. Not much going on in this market. I needed to get my theta back up. My theta is now positive because you have to recognize too, every time I buy, even though they're cheap puts, they're out of the money, they're longer dated, they are chewing up some theta. So I wanted to get a little bit. So that's what the short strangle is doing. I looked just before this call, and I can see that vols, and I saw right after the FOMC didn't do anything, we had IV start to move down to new lows. So we just keep creeping down and down and down. So I'll see what happens by next week, and I might put on some other strategies. I might look at a 1x3, which Richard will explain after a little bit. But Richard, why don't I hand it over to you if you want to just kind of talk about some stuff that you have on. Then I'll go through the slides I put for the ratio spreads, and then you can share those positions.
Yeah, sure.
Let me just turn my screen off. So I hope that made sense to everyone.
Okay, is this the right? Okay, yeah. Position-wise, so I've got some residual positions expiring tomorrow. Nothing too exciting there. It's all looking. We took a bit of a gamble on some overnight calls. I think they'll be okay. And then 29th, that's Saturday. We found a bit of value on the 10 delta on the Saturday. Vols normally drop off on a Saturday heavily, so this will get kind of worthless, I think. And 4th of August, we've got a couple of positions. Normally, I'd have a lot more positions on in the 1 week, but I've been holding off prior to the FOMC, so I've just resumed selling vol this morning. And then my pre-FOMC trade was actually you see here I'm long the 0.2 of the 29,500s, and I'm short 0.6 of the 30,500s. And I was actually able to do that trade at a net credit. The price is now so 253 versus 134, so it's still, yeah, there's still value there in time value. So on that trade, the rationale for this trade is that if we go up, I don't think we're going up very far. So we might get like $1,000 rally, maybe, in which case my 0.2 long calls will be in the money. And my 0.6 short calls will start getting closer to the money. So I'll think about either rolling them or gritting my teeth and weathering it. But it's a super short dated position. It's 14 days to run. So if that is wrong, I can roll those 35,500s out to 31,500 somewhere else, and eventually get rid of them. So that won't matter too much. And all the while, I'll be picking up the long gamma of the long delta in this 0.2. I did the same on the downside, but on that downside trade, I actually got, I think it was for zero premium total. Because I just didn't. Again, I thought downside was probably more likely than upside, but I just didn't see a massive sell-off. I just didn't think people are in the mood to get scared at the moment because nobody's got any leverage, right? So sell-offs are going to be slow, as well as rallies. I mean, unless I don't know, the U.S. government comes out and says death penalty for anyone owning Bitcoin or something like that, then that causes a sell-off. I can't hear you, Shane. Are you on mute?
Oh, sorry about that.
Yeah.
I was chuckling at your comment. Yeah, and I really think it's going to be news driven. Whatever big move we see next, whether it's a 5% move or 3 or 12, I think it's probably going to be a news driven event. So there's nothing else happening.
Yeah. So my rationale here was that I wanted some long gamma exposure, but not too much, and I didn't want to pay for it. So I thought, well, I'm a natural short seller. I'll pick up some long gamma, but I'm going to cheat and I'm going to sell some short dated gamma around it in more size to pay for it. So if we flatline and do nothing like we kind of are, then I'll get paid anyway. I'll get paid a few basis points, maybe 100 basis points, something like that. And if not, then I can pick up the gamma. And if vol goes crazy, then I'll win on the vol. I can just sell those positions, and again roll those short dated positions, because rolling short dated positions that have gone wrong to longer dated ones is always easy. If vol goes up, then the price of an option is that roughly the volatility multiplied by the time to run. Well, because there's only 2 weeks to run, the time to run isn't very high. Therefore, vol times time isn't very much. So if I sell that, if I buy that back and then sell it in a month's time for vol times time, that's twice as much time, and I can make more money. So
For sure.
I'm not afraid of selling those short dated calls and puts.
And as I mentioned at the beginning, I was really hunting for a butterfly. I really wanted to put one on. I really liked them, but I wanted to do it at a net credit, and I just could not find it. I couldn't make it work.
There's not enough smile, I don't think, in around the money. Beyond 10 delta, there's a bit more smile, but beyond 10 delta in 2 weeks, there's no premium. So.
Exactly, and I didn't want to go too far in time, so I let that go, and that's why I was happy just to put on the July 28th long strangle, just to all right, it's going to be cheap, and I thought as soon as the FOMC is over, if nothing happens, I'll buy it back. Might lose a couple of bucks. Again, I made a little bit of money on the calls, lost a bit of the puts, but it was just in case, it was an insurance bet.
Actually, probably a good trade right now is actually selling risk reversals, maybe 1 or 2 week risk reversals. Because actually what you're doing there, if you hedge it, if you delta hedge it to 0 delta, just hedge it daily. Because what you're doing is you're kind of allowing yourself to be slightly long the market, but protected on the downside. And at the same time, you're picking up the implied interest rate, which is about 5%. Let me just check. I click on the futures tab, 1 week. Actually, no, overnight it's 24%. Yeah, 7%. 7% for a week, 5% for 2 weeks. So selling a risky and delta hedging to 0, it's probably not a bad trade, because you're going to pick up something. You're on mute again.
You know what? I never do that, but I've got this annoying cough, so occasionally I'm muting myself when I'm coughing, and I forget to unmute. But yeah, so risk reversal, we're buying those puts and selling the calls.
And what else? Oh yeah, I sold my first October today. I saw October came out, so I sold a 10 delta call in October.
Yes, I saw that come out too, and actually I bought a put, but because I don't want to sell that far out just yet. But
because I'm thinking October, 42,000 Bitcoin, no chance.
Yeah, it's almost, I don't want to say it's free money because the market gods have a way of smoting you.
Yeah.
But it almost seems like free money right now.
I've got $12,000 of strike to hedge that if I'm wrong, right? So
exactly. It's not going to go from 29 to 42 like instantly. Well, market gods don't smote me, but we probably have time to adjust that. So
if it does, then the vol spike will be enormous, and I won't care about that 0.1 of a Bitcoin because I'll be selling 5 Bitcoins of premium at 100K.
There you go. Perfect. And there's the perfect strategy for anyone who wants to know. If we spike to 42,000 in one day, we'll be selling the 100K calls. Let me tell you.
Absolutely, damn right we will.
And we've had the conversation before, maybe a year ago, where when Bitcoin was, up in the 50s, we were talking about selling the 100Ks. We're like, it seems like free money. Should we do it? Well, what if? And we were probably looking at about, 8, 9, 10 months out. And sure enough, it was free money.
Free money, yeah.
Anyways, hang on. So let me just go back to the slides. If you stop sharing your screen.
Let me unshare my screen, yeah.
I've just got a couple of little... Okay, so what I did was, we're talking about the 1x3. I love the 1x3 in certain situations. There's times when you don't want to do it. The other thing is that if you can't, if you're going to go on holiday, I'm not going to do anything if I'm going to go on holiday. It's going to put me in jeopardy. I'm not going to leave anything naked. So just bear that in mind. So we're, at times we're happy to take on a bit more risk in certain environments. So let me just go here. So a 1x3, it's a ratio spread. Usually when people talk about ratio spreads, they're usually talking about a 1x2. That's kind of the typical jargon ratio, but 1x3 is great. You can do a 1x10, whatever you want, right? It's a ratio. So it's 3 or more components where you've got a long option, and that long option is usually at the money or in the money, typically, and then you're selling 2 or more short out of the money options against it. You can do this for a debit. You can do it for a credit. Just depends on where those strikes are, right? And that max profit is if the underlying closes at the short call strike price at expiration. So if and that's if we go with a long call and then we sell some calls at a higher price, well, we want that long call to appreciate in value. We want the options to expire right underneath those short strikes. We keep everything. Is that going to happen? No. 90% of the time that will not happen. But if we can get close to that, that'd be lovely. So it's neutral to slightly bullish or bearish if it's a put spread.
You know what? I like the idea of going long one of the 30 delta and then short 10 of the 10 deltas. So that's an interesting trade.
10. Okay.
Yeah.
Let's talk about those numbers and maybe we'll put one on. Well, and I'm just thinking about the curve right now. It's pretty flat, as you said, and let's not stick our neck in the guillotine just yet on that. Let's think about it before we do that one. But we don't want to lead anyone astray.
Yeah,
more astray than usual. Anyways, all right.
Yeah.
So here's a call ratio spread payoff diagram. Very simple. Over here, I assume you can see my screen there, or my little cursor. Actually, I've got the whiteboard. You got the little pen over here. Here's the long strike right there, and here's the short strikes right there. Right. That's all there is to it. Is you're buying this long call, and we're selling these short strikes. So it gives us a little bit of room on the downside. So if the underlying asset does increase in price, we've got a little bit of wiggle room before our break even. But after that, if it's a 1x3, we do have two naked calls that we're going to have to manage. Close off, or we're going to have to roll out or split into a strangler, or whatever we're going to do with it, we're going to have to manage that. But the reason why we like this in this environment is nothing's moving very much. We do have the long call, which is nice. We can keep that long call. Let's say things did go up and started to press our short strikes. Well, we can keep the long call, and we can roll the two shorts out and let that long call ride and just get worth more and more. Eventually, in this environment, I feel like it's pretty easy to kick the can down the road and make money overall on the whole damn thing. Same thing, put ratio spread, just flip it around the other way. We've got the long put here, sold, 2, 3, however many you're selling there. And it's just a very, very simple diagram. So we're using them at times now because we want to play breakouts or news. So the market's going to move somewhere. It's not going to stay here forever. I guarantee that. Guarantee that. Of course, and we can guarantee that.
I mean, we're in a situation where we're saying the market's not moving. Actually, the market's moving up and down by sometimes $1,000 a day. But we're just not noticing because there's no trend.
Yeah, stuck in this range. So, it's a nice way to play the breakout. But in this environment, the breakout usually doesn't go very far, and that's what we're betting on. It's not going to go as far as our short strikes. So we don't think there's going to be any significant move in the market. We don't want to just pay outright for a directional bet because, the market could stay like this for months. Who knows, right? And we'll just eat up cash, burn through cash. That sucks. So if we're going to put on a bet, let's be paid for it. Let's make something, or at least not have to pay for it if nothing else. And, again, as I mentioned, if you're going to go on holiday, well, don't do this. We're comfortable managing those naked short calls if we have to. Yeah, no problem. We'll just manage them.
And the other thing about the 1x3 is it's quite nice because it gives you a net credit if you do the right strikes. If you do about, I don't know, 30 delta to 20 delta or 30 delta to 15 delta, something like that. It'll pay you net premium, which means that if it goes the wrong way, then you still get paid.
Yeah, and I think with your trade you have on, actually, if you want to share your screen and show, I think you put the 1x3 on. That'd be great. Yeah. But, you're going to get paid something, even if this market doesn't do a damn thing. And that's nice, right? Versus putting something on and having it expire. And, oh, my gosh, I'll put something on again, having it expire. So you're going to get paid something no matter what.
Yeah. The only way I don't get paid here is if we dump below about 26,500 or we rally up to, I think, 31,500. And then I've got to do something about those short calls, but that's fine.
What are the numbers for your 1x3?
I think the break even is.
What are the strikes, Richard? Sorry, I missed that.
Oh, sorry. 29,500 is my long call. And then my cover is $1,000 away, so 30,500.
Okay, beautiful. So you sold the 35s, 3 of them, and you bought
Yeah.
one of the 29.5s.
Yeah.
I'm just looking at the Bitcoin chart now, and you did some on the put side too, right?
Yeah, the ones I did on the put side, I did for net zero premium,
Mm.
and that was I bought the 28.500s and sold the 27.500s. So I was just looking for a play on, if there's huge disappointment, or if someone sees this as an opportunity to offload some bitcoins, or
Mm-hmm.
something like this.
Yeah, and those are August 11, right?
And had that happened, I would have just rolled the 27.500s out, and then delta hedged the 28.500s and played the gamma.
Mm-hmm. Just that's 11th of August, right? Those
Yes.
are the 15
Yeah.
days.
I tried. I 2 weeks. I gave myself some time.
Yeah. No, I like that. So, and you got paid for the calls. Great. Both of us didn't expect anything to happen, so this is just a kind of a what if. So that's great. Can earn a little bit of money while we're sitting on our hands waiting for the market to move. It's interesting because I haven't been paying as much attention to Bitcoin lately because I don't have any positions on. But last week we talked about it. It broke below its little sideways trend, and it's staying below there for now. Again, in these super low vol environments, it doesn't really mean all that much, or it has less meaning, I suppose, because it could easily pop back up in the range in 10 minutes, and that's it. But
yeah, and if you were going to put this trade on today, then I probably wouldn't put it on at 29.500 now. I'd probably put it on.
Yep.
Actually, I'd go long at 30,500 probably, and then short at 31,500. And if you look at the vols, you see I'm paying 32.7 vol, and I'm receiving 35.2. So vol wise, it's the right trade. I'm playing the smile, and I'm selling more of the more expensive part of the smile than I'm paying for. It still works.
Okay. Yeah, and depending on the type of trader you are, depending on your availability, I might be looking at a 1x5 later. Maybe I'll sell it in 1 week. I'll do a shorter dated one. Who knows? Like I like to be creative with these. In a high IV environment, I'm not going to do that. I'm going to be much more careful. I'm going to widen those strikes way out. But I think
that could work, right? If you look at the 12 delta, 32,500 is here. It's at 38.7 volt. So if I sell 5 of those, I'm receiving 215 basis points. And if I buy one of the 30,500, I'm paying 135 basis points. So
it's not bad.
It's an 80 basis point premium, right? And picking up some long gamma and getting paid to do it. I think it's all right.
Yeah, I think actually flip over. Would you mind just take a look at the Ethereum options, Shane, and see what the Ethereum trade looks like similar for August 11th. If we can find similar IV there.
30 delta, we could pay 105, and 12 delta, we could receive 100, 200-ish, just under 200. Yeah.
Okay, that's not horrible either.
Yeah. 2050. What's Ethereum at right now? Yeah, that's reasonable.
1875 or so, around there, I think.
It's got to be a pretty hard resistance at 2000, right? Yeah, on Ethereum.
I like the 2000, and I'm just looking at my trading view chart. That's where my short strangle, the 11th that I have on. That's where I put my calls at. So because of that.
You know what? I've got a bunch of spare margin. I could do that trade now.
All right.
Let's see. Let's pick up one of those at 105. We'll just bid for that. And I'd say 12 delta. I'm offering 5 of those at 39. Yeah, fine.
Yeah, if anyone has any questions about this, feel free to ask in the chat. We'll head over to the Q&A pretty quick. And I guess that's about it. We want to talk about the 1x3. And again, what we want to do, we're going to do for the next couple of weeks, is we're just going to cover low IV strategies because that's the environment we got right now. So these are the trades we're going to be putting on. So every week we'll probably be putting on the type of trade that we feel comfortable doing in a low IV environment to earn some money, because directional bets are fine, but most of the time they're not going to work out, right? So we don't want to have to live off that, but we don't want to stick our neck out too far selling in a low IV environment. We need to be able to switch gears really quick because as IV starts to tick up, we're going to need to flip that strategy toot sweet.
So here's the chart. Here's the low IV environment. Here we're at the absolute lows of implied vol for this year.
Yeah.
Although this implied vol is 35.9, so this is the 1 month, the 30-day vol. This seems low. It's actually reasonably high for a stock, but it's Bitcoin is now, or ETH is now trading at the same sort of volatility as a reasonably volatile stock on the S&P 500. You look at the historical vol over the past 15 days, we're at about equal. But if you speak to a market maker, I spoke to a options market maker this morning. They were telling me that actually realized vols are more like 19%. So you've now got
Wow.
Bitcoin is like less volatile than Microsoft stock.
Wow. Yeah, that's extraordinary. And who would have thunk that it would have happened so quickly?
Yeah. So the corollary of that is that the trade is still selling vol. Implied vols are still trading at about 14 vols over realized, but just don't do it in massive size, because if it does go, it's going to go hard. And hurt you.
Or have the protection on, or be there to manage it.
Yeah, because if we get another one of these spikes up to say 60 or 70, we're now doubling the vol, which means you're doubling the price of all your options, which is fine if you're on a 1 week or 2 week, but if you're on a 3 month or 6 month option, doubling the price is going to really hurt.
Yes, indeed. Hurt would be an understatement for sure. All right, so let's jump over the Q&A. We do have some questions here. A couple from Luke. Sorry, Richard, was there anything else you wanted to share on that, or are you good?
No, that's fine. I think questions are the best way to get information across, right?
Okay. So Luke's saying, if you have a delta neutral strategy and are hedging with futures or perps and you want to get filled as a market maker, what do you do if you don't get filled? And what are the tricks to getting filled?
Yes, that's a good question. We've got a few things here. I need some Marcus questions. Marcus question and Marcus question. So where are we?
It was you moved it. So I asked a question.
I think you're supposed to go up from the bottom.
Because I was reading it on the chat, not the Q&A, and then you moved it.
Sorry, dude.
That's okay. But no problem. I can read it again if you want.
Right, minimize hedging costs. Yes. Okay. So it's really important, particularly if you're not on a retail account, and actually also if you're on an institutional account, to minimize your hedging costs. So I never act as taker of futures or perpetuals. I always act as maker, and I will sit there for an hour if I have to, just re-quoting, just either side of the bid ask before I get filled, and it's just a case of continually quoting. And if the market moves, you just move your quote, which obviously means having a computer to help you do it makes life easier. And that's exactly what we do. We look for the mid price and we quote just above it or just below it, and we hold that quote for 30 seconds or a minute, and then we look again and either modify the quote or leave it in until we do get filled. And eventually you'll get filled. I mean, it could take 20 minutes, but in my systematic regime, I hedge every hour. I run risk every hour, and I hedge the delta to zero religiously. And if I did that while paying retail taker fees, I would end up burning about 20% of my collateral every year. By acting as maker on the perp, I'm paying zero, so I can afford to be a lot wrong in terms of the price I trade at before it matters that I'm trading at the wrong price. And if you trade on the 1 or 2 week futures, they'll actually pay you, even if you're retail, they'll pay you maker fees of 1 basis point. And 1 basis point on Bitcoin is $3, right? So you can afford to be $3 wrong.
Yeah, I agree.
Well, actually, you can
Well,
afford to be three times five, $15 wrong, and still be right by being a maker.
I just realized something that I don't know offhand, and maybe you know the answer to, Richard. So, depending on the system you use, and I'm thinking about equities, if whether you're using ARCA or Brew, it doesn't matter, the order entry route. If you put in like iceberg orders or hidden orders, and sometimes if you're making the market, you don't get paid anything, or it's flat or fees. Do you know how it works on Deribit? If you don't
Yeah.
see an order there and you go and all of a sudden you get filled because someone was sitting there hidden.
Yeah, the iceberg is always treated as a taker, so so you'll be maker if you touch an iceberg. Yeah.
Nice. Okay, I assume, but that's great. So Luke has a couple more questions regarding the 40 vol strategy, and that was the strategy we talked about before, where we were selling the weekly 40 delta call. In that example, we were just letting it run to expiry and not managing it, which is something we wouldn't recommend. What if the 40 vol isn't available in the options chain?
Yeah, there's a good chance it won't be.
To it.
So here we are on Bitcoin. Yeah, at the moment, there's the 30,000 is at 42 volt. Sorry, 42 delta. I presume you meant delta, not 40 volt.
Yes.
Although actually, Luke, 40 vol is a bit of a magic number for me. I don't like selling vol under 40, by the way. But right now, you kind of have to. Yeah, if the 40 delta isn't available, it often won't be. Then you can either just pick the closest, or you can interpolate. So you could say, I'll take the one either side of it and trade some ratio between the two. Whatever regime seems right for you. And it kind of doesn't matter that much. I mean, it's not that 40 delta is a magic number. It's just that of all of the numbers we tried on the constant maturity volatilis, that was the one that came up with the best returns. But that's not to say that 42 might not be better, or that 38 could be better. I mean, who knows? Well, we'll know if we backtest it. But in general, I just try and get as close as possible. I used to carefully compute how much of the 35 delta should I sell versus how much of the 50 delta. But I don't bother these days. I just pick the closest, and because I'm just doing a little bit every day, it all averages out anyway.
He had another great question too, and this is a topic of a lot of conversations. What's the trick to be gamma positive or gamma neutral when your strategy is selling? Because sellers were almost always going to be gamma negative, right?
You're always going to be short gamma if you're short. If you're long theta, you'll be short gamma for sure. Unless you've got some bizarre situation where, I mean, if you were long some long dated thing that was super high vol and the short dated was super low vol and you were short it, then maybe. But I don't. Yeah, it would be an anomaly, right?
So the thing is crypto's 24/7, and if I'm a seller, the market's kind of doing its normal thing. I'm just going to be long short gamma. That's all there is to it, and I'll just have to manage that. We can hedge it off. That's the trick, I suppose.
One thing I do is I do sometimes compute where can I get the most theta for the least gamma. If you do that kind of dumbly, do it for every single strike, what the computer will tell you is that you should be trading the 1 delta, 6 month calls or something, and receiving nothing for them. But that will be the best theta per gamma, but it doesn't take into account trading fees and so on, and hedging costs. But I'm generally looking for the most efficient theta I can get. Tends to be in the 1 or 2 week tenors, actually, either 1 or 2 weeks or 6 months.
And in my mind too, let's say I'm short delta doom. The market makes a pretty big move, and then I make some type of a shorter term directional bet. My overall gamma might still be negative, but that directional bet will pay off. I'll close it and I'll go back to managing the short. So it's kind of a dynamic thing. Now, the one thing I will say, if you're trading equities, for example, well, the market closes, right? So who knows what's going to happen? You wake up tomorrow morning, the market can gap up, gap down, and that's where your real danger lies. So, before you go to bed, before the market closes, you might want to buy some overnight protection to give yourself neutral or slightly long gamma. Get rid of it in the morning, a one-day option or a weekly, whatever. You can do things like that to just protect yourself if you're quite heavily short gamma.
Yeah.
Okay. When I hedge okay, question from Dom. When I hedge my options delta, do I need to hedge the net delta as I was selling 1 Bitcoin of options, then getting long 1 Bitcoin of futures? This leaves me with long delta still. The goal would be to accumulate more Bitcoin.
Okay, if you're going to if you're hedging into dollars, i.e., you're accumulating in dollars, then you'll need to hedge the total delta, not the net delta, and you'll also need to hedge the underlying coins that you own. If you're hedging into Bitcoins because you want to accumulate Bitcoins, then to stay delta neutral, you should just hedge the net transaction delta only of your position. And you can, am I sharing still? Yeah, you can, positions, you see this checkbox here, net transaction delta, that will change the delta you're seeing. And net transaction delta, if I can remember properly, will show you the delta that's due to the option PV movement, not the delta that's due to the intrinsic value. Because whenever you've got intrinsic value in a Deribit option, you are effectively long Bitcoin, so you're short dollars. And so if you click on that takes that into account. And if you click on the checkbox, then it shows you just the Black-Scholes delta in Bitcoin terms.
Clear as mud.
Clear as mud, yeah.
All right. Another question from Luke. Can you explain who, or probably how, to set up an arbitrage between implied vol and realized vol?
This is very simple. All you've got to do is build a time machine and go back 2 weeks in the past and sell an option if the implied vol is higher than the vol you realized over the past 2 weeks before you went back in time.
Okay. What if we don't have a time machine?
Well, then you've got to guess. So what you're seeing here, if on this one here, is you're seeing a weighted average of the realized volatility over the past 2 weeks. And so it's obviously already old and wrong, but it's better than it's the best you've got, right? So it's kind of telling you that vol seems to be trending downish now, and it's quite low, the realized vol. And so theoretically, looking at the range of this stuff, if I'm selling options of 35 vol and I'm hedging efficiently, then I should make money, right? Because I'll pick up all this area between 35 vol and this line. If the market carries on now, it continues to do what it has been doing for the past 2 weeks. Yeah.
So we've got a question from Jean, and I'm a little bit concerned about her. I feel like, I guess Jean, I've known Jeans who are both male and female. I think the Jean is going to the dark side.
Yeah.
And she said, have you started to find alternative to Bitcoin and ETH to sell higher vols, like selling altcoin options?
This is the road to madness. Yeah.
It is the road to madness.
To be honest, you could, if you have enough money, you can go and open an account with firms like what are they called, Galaxy Digital or STS or IMC, and you can dump $500,000 of collateral with them and then trade over-the-counter options on pretty much anything you want. They'll make you a price, but you will trade the price they give you, and when you want to exit, you'll exit on the price they give you, and you're trusting them for their settlement prices and their index prices every day. No,
sounds great.
I mean, you'll sign an ISDA with them, and you'll sign a waiver to say that you're a professional investor and you're high net worth and all the rest of it. But I'm guessing if you were high net worth, you probably wouldn't be bothering your time learning stuff from us, and you certainly wouldn't be bothering selling vol on altcoins for a living. You'd be doing something else that you could sue somebody for if they did it wrong. If you're looking for more vol, I mean, you might want to look at Tesla stock. I mean,
Sometimes, commodities will spike.
And
sometimes.
Tesla stock is probably a good proxy for Dogecoin.
Good point. Yeah. There are some platforms I looked at, maybe 6-8 months ago, that were these decentralized platforms, and they had options on some different, at the time was Luna, Solana. Deribit did have Solana too for a while. Some other ones, but it just didn't seem. It wasn't something I was willing to entangle myself with. So, yeah. Let's wait for the vol to come back into Bitcoin and Ethereum. It will come back. It will.
I did do a trade actually last year on Tesla. I sold a risk reversal on Tesla. It was coinciding around the purchase of Twitter.
I remember that. I think you were calling it your trade of the century or something like that.
Yeah, it was. Trade of the decade. Yeah.
Trade of the decade. Excellent. Okay, good. Well, we'll check back in 9 years, and we'll see how that's done. All right. Another question from Luke. How do you minimize the hedging costs while maximizing the premium protection?
By aggressively market making the perpetual. And also, if in the final week, I also try to match the delta from the options with the delta from the dated futures, so that I don't get suddenly put into a massive delta on expiry. But I do that by making, and I'll just sit there and sell 0.1 of the future, the dated future, and then buy back 0.1 of the perpetual, and keep on doing that on a market making basis, trusting that I'm making as much in fees, in maker fees on the 1 week option future as I'm losing in spread.
All right. A question from Alejandro. Don't you think it would be a good idea to buy vol now in anticipation of the ETF decision?
How much money have you got, Alejandro? Probably, but I don't know if you've ever seen the film The Big Short, where the genius hedge fund manager, shorts the housing market, and he's absolutely right, but his clients all leave him because they don't share his faith, and they bail out the fund because the fund's down 20% or whatever, because it's paying the premiums on the long gamma, the short theta on the trade. So it's the same trade, right? You're right, and you're going to be right in the long run for sure. But how long that long run's going to be is anyone's question. Could be a month, could be a year. Can you afford to pay your theta bills for a year and still feel good about it? And in 9 months' time, when you've been paying 9 months of theta, and you've maybe paid enough premium that you could have bought a Ferrari instead, and you'd have lost the same amount of money but had more fun. You've got to be able to answer to yourself, and so everyone has their own threshold on that. So what we try to do is we sell vol to make premium, and then we use some of that premium to buy vol, and sort of just gradually try and build a long vol position that way. And that's probably why you see that longer dated vols are higher than short dated vols, because people don't want to be selling long dated vol because there's such massive vega risk. So they're selling short dated vol and they're buying long dated vol because they're doing that exact trade. Excuse me. And if you look at the implied vols in December, say the at the monies are 44.9 or 44.8, right? Or, say 45 vol, and look at the 1 week is 30 vol. So there's 15 vol premium for buying long dated, and that's exactly what people are doing.
Yep. And if you do, if you have a hunch that it's going to go up in 2 weeks or 1 month, you could always buy it as a spread, so at least you pay less. So you're going to cap your upside, but at least you're paying less. And if it doesn't go, well, you can do it again and again. And at the end of the year,
yeah, you know what? I hadn't checked, but the smile is probably quite aggressive on the December options. So if you were to buy at the monies, you'd paying 45. But if you were to sell, you could sell the 25s for 50. Interesting. You could probably do like a 1x3. I'll look into that. That might be a good trade.
All right, cool. Question from Gene: are you using second order Greeks aside from gamma? Absolutely.
So you mean things like Vanna and Volgamma? I do for my daily explainer reports, which are prepared for me by a quant. But in terms of my day-to-day trading decisions, no. I just don't think the market is that finely tuned that it matters that much. For me.
Yeah. Okay. Luke says he has some questions over there. No, he doesn't anymore. I think we got all your questions, Luke. Let us know if we didn't. I'm just taking a quick look at the poll. So 68% of people said no, they did not put on a strategy for yesterday's FOMC. I'm not at all surprised. Most people I knew were just sitting on their hands. There's a few people who are gung-ho who thought for sure something was going to happen. But as we saw, nothing did. So I'm going to end that poll. But yeah, I'm not surprised there.
We're going to need to see some real stimmy check action to stimulate the crypto market, I think.
Yeah, we need some news for sure. The ECB came out, as we mentioned at the beginning of the call already. They did what they advertised. I think it was a 25 basis point. Japan tomorrow, don't think anybody cares.
I'll tell you what would be bullish for Bitcoin is if the government stopped pussyfooting around and actually declared full-on World War III. That would do it.
That would do it. Yes, let's not do that though, Richard. There's got to be a better way.
War's always good for business and great for trading.
That's true. How about an old-fashioned financial crisis?
Everyone's bored of that. We've been in a protracted financial crisis for the past 25 years. No one gives a shit.
Maybe we need a big market crash, a stock market crash, and everybody will pull their money out and flood into crypto, right?
It won't work. Nobody believes market crashes anymore. If the market crashes 20%, we know exactly what's going to happen. The Fed will print money, and the market will recover the next week to double what it was before. No one cares. No one's got any concept of risk because there is no concept of risk because whatever happens, the answer is fuck it, print money and give it to people.
Well, even when you look at 2008, for example, I mean, it didn't rebound always in a week. It took a while, but I think S&P was this morning. I think it went to 2023 highs. Up and away. So. We'll see what happens. I think that's the end of the questions. We're almost at the top of the hour, so I think that was great. I hope you guys got some value out of this. We do use the 1x3. Richard did it on both sides of the market, as you can see. And we're going to keep focusing on low IV strategies for the next couple of weeks because they're nice to have in your back pocket. And we'll also try and do some execution of those strategies that we happen to talk about. So until next time.
Yeah,
thanks.
I'm gonna put on some of those 1x5s. I like those. We should do
okay. That was an ETH.
I'm trading a Bitcoin book at the moment, but I could do both. Yeah, why not?
Yeah, cool.
I did do one, didn't I? Yeah.
I think you said you were buying the 30 Delta, August 11, 30 Delta, and you were selling 5 of the 12 Delta?
Yeah, I'm just waiting to get filled now. Sorry, okay. Yeah, I've got the memory of a goldfish. I forget what I traded even after I've traded it.
Okay, fantastic. Hey everyone, we'll catch you next week, and happy trading, friend. Bye bye.
Okay.